The MRA plus 10 provision under FERS is a retirement option that provides an immediate annuity to federal employees who have reached their minimum retirement age with at least 10 years of service. However, during periods of downsizing and restructuring, the MRA plus 10 retirement can feel more like a barrier than a benefit for some federal employees. In this video, we're going to discuss some of the key advantages and disadvantages of being laid off under the MRA plus 10 provision. But before we dive into the details, welcome to the Money Briefing. My name is Jarrell Harvey, and I'm with Fedway Financial. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider sharing and subscribing. Facing a reduction in force can be a challenging experience for many federal employees. A RIF often requires you to make difficult and unexpected decisions, which are generally influenced by your age, years of service, financial stability, and family responsibilities. For a particular segment of federal employees that fall under the MRA plus 10 provision, this situation can feel especially challenging because you can qualify for certain benefits, but you can also lose out on several benefits. This could cause you to feel stuck in the middle between what choices to make. The MRA plus 10 retirement eligibility applies to FERS employees who have reached their minimum retirement age, or MRA, which is between 55 and 57 based on your year of birth. You must also have at least 10 years of credible service, and 5 of those years must be tied to civilian work. When it comes to a reorganization or a reduction in force, the employees that are most adversely affected by the MRA plus 10 provision are those who fall between their MRA and age 62 and have between 10 years and 19 years of service. Individuals in this group do not qualify for early retirement programs such as a VERA or discontinued service retirement because they haven't reached the required 20 years of service. They also do not qualify for severance pay since they are eligible for an immediate pension benefits. Even though they can start receiving pension benefits, they don't meet the criteria for a full unreduced pension right away. Because of this unique dilemma, I want to explore some of the potential trade-offs for federal employees that fall within this specific category. If you're laid off due to a RIF or some other type of agency restructuring, you have the option to start your pension immediately after separation, or you can postpone your pension to a later date if you decide to start your pension right away. You must complete Standard Form 3107, which is the application for immediate retirement. With this option, your first annuity will be reduced. The reduction amount is based on how many years and months that you are under age 62. The monthly reduction is equal to 5/12 of 1%. This chart shows how the monthly reduction breaks down based on percentage. A full year is equal to 5% reduction. In other words, if your pension starts at 58, you could face a reduction up to 20% because you're 4 years away from age 62. This reduction is permanent and it does not stop when you reach age 62. When you retire under the MRA plus 10 provision, you are not eligible for the first supplement and you do not get a cost of living adjustment until you reach age 62. Therefore, without the first supplement and without a cost of living adjustment for perhaps a few years, this can create a financial void because you have to solely depend on your pension and personal savings and investments unless you get a new job or have other sources of income, such as things like a military pension or a VA disability benefit. On a positive note, you get to maintain your health insurance and life insurance assuming you meet the immediate 5-year enrollment requirements. During retirement, the government continues to pay their portion of the premiums. You can also keep your dental and vision coverages as well. If you're under age 59 and a half and need to tap into your TSP, you can do so without the early withdrawal penalty because of the rule of 55. Let's now pivot and talk about postponing your pension payments. So instead of taking an immediate pension, you can choose to postpone the start date of your annuity, which can potentially lower or eliminate the age reduction penalty. However, this can still come at a cost. If you postpone your pension, this means you do not get any income from the federal government during the postponement period. You could potentially qualify for unemployment compensation, but most states limit unemployment benefits to 26 weeks or less, and there's typically a cap on how much you can receive per week. So, as we discussed earlier, you must have other sources of income to cover your living needs. Another big loss with postponing your pension is the temporary suspension of your FEHB benefits. As an alternative to your normal FEHB coverage, you can get the government's temporary continuation of coverage, which is also known as TCC. This coverage can provide health benefits up to 18 months. TCC is essentially the government's version of COBRA for federal employees. With this coverage, you pay the full premium for your selected plan plus a 2% administrative fee. Outside of the federal government, you can get coverage from the health insurance marketplace. Another potential option is getting health insurance from a new job or from a spouse's job if you're married. Once you begin your first annuity payments, your regular FEHB benefits will get reinstated. When you're ready to start your pension, you should submit Form RI 9219 to OPM at least 60 days before the date you want your annuity to begin. If you want to completely avoid the age reduction, you could pick a date that is less than 1 full month before you reach age 62. But that date should also be at least 2 days before your 62nd birthday. In other words, let's say you turn 62 on July 15th. You can avoid the age reduction by choosing your annuity commencing date on any day between June 16th and July 13th. If you're rehired by the federal government before beginning your pension payments, you will be treated as a regular FERS employee rather than a re-employed annuitant. Also, if you pass away before actually filing an application for retirement, you will be deemed to have filed your application. This will allow your annuity benefits to kick in for a surviving spouse. Your spouse can also resume FEHB benefits if they qualify. However, there is no payout of federal life insurance benefits if you pass away before your pension begins. But once your annuity starts, the federal coverage will be restored as well. If you fall under the MRA+10 retirement eligibility with between 10 and 19 years of service, it's important to carefully consider the benefits and drawbacks of starting your pension right away versus delaying it after a federal layoff. This decision requires thoughtful evaluation of your financial needs and personal situation. Every federal employee's circumstances are different, so it's important to make a choice that aligns with both your current needs and long-term goals. If you've received any value from this video, please click the like button. You can also subscribe to our channel to get more content like this. If you're interested in seeing how we help our clients at Fedway Financial get the most out of their money and federal benefits, please visit our website at www.fedwayfinancial.com, where you can click on the meeting link in this video's description. Thank you for watching, and we see you on the next Money Briefing.